So you're thinking about moving and relocating to San Diego, California. Now you're curious about a conventional loan or an FHA loan. Why one, why the other? So on this video, we're going to be talking about the top 10 differences amongst the conventional and the FHA loan. So if you want to know that information, stay tuned and keep watching. What's up, amazing people? I'm Liz LeFore here with the MortgageLiz team located out of San Diego, California. And on this channel, we talk about all the best home loans. So if you are interested in any of those details, you're going to want to subscribe to this channel, click that bell, because it's really important to get reminded about every single video that I release every single week about all the best home loans and what it's like to eat, sleep, live, and play here in San Diego, California. So today, we're going to be talking about the top 10 differences between FHA and conventional and why go with one and why go with the other. All right, so let's break down the conventional loan and an FHA loan. This video is going to be loaded with a lot of information. So first thing is that a conventional loan is not backed by the government. It actually has two different entities of where your loan could end up. Either conventional, which is Freddie Mac, or conventional, which is Fannie Mae. Both of those different entities have different guidelines. And in essence, they could also have different requirements as to what you can and cannot do. So today, we're just going to be talking about the basics amongst a conventional loan. And so with that, we're going to be comparing it to an FHA loan. What is an FHA loan? It is a Federal Housing Administration loan, and it is backed by the government. They are completely different, have some similarities, but have way more differences than similarities. And so we're going to be talking about all the differences, but did you know 25% of new first-time home buyers actually obtain a home loan from FHA? So the first main difference amongst the conventional and the FHA loan is going to be the down payment. On a conventional loan, a basic program, you're going to be looking at 3% down, whereas FHA loans, you're going to be looking at 3.5% down. With the 3% down, that can go towards either a Freddie Mac or a Fannie Mae loan, but it just gives you the ability of having a little bit less down coming out of your pocket, or possibly, stay tuned, we're going to be talking about down payment assistances a little later in our video. But number one is going to be the differences of 3% or 3.5%. We're going to be talking about the credit score differences, where a credit score requirement for a conventional loan would be at a 620. An FHA loan, you're looking at a 580, sometimes a little bit lower, could go to a 600, can possibly be a 620, and we're going to be talking about that because there's a lot of details when it comes to an FHA and all the extra stuff that comes along with it. And on to number two, the FICO score or the credit score. Same difference when it comes to us as lenders as to what we're looking at. When it comes to a conventional loan, you're really going to be looking for a 620 credit score. When it comes to an FHA loan, that's where it gets a little bit of trickiness. Okay, so we're going to start off with an FHA loan can go as low in some cases to a 500 and a 580 credit score, depending on the lender and which their credit score requirements they have specifically within their company. Because FHA, not everybody can do the lower credit scores under 580. And remember, the lower the credit score, the higher the restrictions. So there are some additional requirements that you're going to have to take on when you have a credit score underneath a 600 and a 620 when you're thinking about doing an FHA loan. And so we're going to be talking about a little bit about that because it does change what we were talking about a second ago, which is the down payment. Because at a 580 credit score, we're not going to be able to do the small 3.5% down, or underneath that 580, it's going to change that detail too. In talking about the 580 credit score requirement, the details that are going to change are going to be the down payment, along with the restrictions for your debt to income. So what is the debt to income? How much you spend in comparison to how much you're going to have on a mortgage payment with all of your debt. So for example, you make $1,000 a month, 45% of $1,000 is going to be $450 a month. With most lenders, the credit score requirement is going to be about that 600 and 620 credit score requirement. Some lenders can do a 580 up to that 600, 620, where you're looking at that middle credit score option per se. The difference is going to be that at that amount, you can still technically do the 3.5%, but between the 580 to the 620, you're going to find that you're going to have a bit more of requirements when it comes to the actual loan. Then we start looking at under 580. When we look at 500 to 580, one thing to keep in mind that COVID has changed a lot of those requirements. So many lenders are not doing those anymore, showing that 500 to 580 is not an available option. With that being said, when the option was available and to the lenders that can actually do it, the down payment is now different. So it's not the 3.5%, it's in fact 10% down, and the debt to income, so how much you spend out of your pocket in comparison to how much you make, is going to be more restrictive. So in fact, you're not going to be allowed to spend 50 and 55% in that higher maximum range of what would be typically okay within a regular 600 to a 620 credit score requirement. So that was a load of information. One thing that you really just need to remember is that when you have a lower credit score, you have more requirements. Sometimes it's just better to be able to work on that credit score to get it a little bit higher, to then drop the amount of requirements or details that are going to be needed for that loan. So on to number 3. The third difference when it comes to a conventional loan and an FHA loan is going to be the mortgage insurance. Mortgage insurance is so drastically different when it comes to a conventional loan and an FHA loan. So first off, we're going to take a deep breath because it's going to be a lot of information again. So here we are, conventional loans. Conventional loans have mortgage insurance and they are credit score driven. So what does that mean? And they're debt to income driven. So what that means is that you're spending more of your income or your credit score is lower, then in fact, you're going to have a higher mortgage insurance. That is how conventional loans are broken up. So if your credit score is per se at a 620, which technically you are still okay for a conventional loan versus a 740, you're gonna find yourself that your mortgage insurance on that 620 credit score, even though it's totally okay to be able to get that conventional loan, it's going to be significantly higher. And I'm not talking like a little bit, significantly higher in comparison to that client that's got that 740 credit score requirement or the 740 credit score. So I did some little bit of a breakdown on my system to see what the true basic numbers were. And when a client that was doing the exact same detail, exact same loan amount here for San Diego, California, putting the exact same 3% down, the difference between the credit score because of a 620 to a 740 of mortgage insurance was pretty extreme. So the 740, they were at 0.26% of their mortgage insurance. Okay, so I did the calculations when it came to that mortgage insurance because in true fashion, we want to make sure that we really kind of see the numbers for ourselves. If you were planning on doing a loan amount of $500,000 here in the city of San Diego and you were planning on moving here, $500,000 with the 3% down with a 620 credit score, your mortgage insurance could be as high as 3.08%. So what does that even mean? Literally, your mortgage insurance could be like $1,200 because of your credit score at 620, depending on, of course, that loan amount, your debt to income, and a whole bunch of other variables. On the flip side, if your credit score was at 720, 740, at that point, your mortgage insurance is so much lower. And we're talking like $108 a month. So at $108, we're talking like 0.26%. And of course, that is the best case scenario in comparison to the minimum credit score requirement at 620. But it's really important to be able to see those drastic differences. So just based on the mortgage insurance, we look at the fact that the mortgage insurance in itself is going to be a bit more expensive when it comes to a conventional loan with a lower credit score. Now, looking at an FHA loan, how does that even vary? So FHA loan is pretty standard. They don't really hit you one way or another, meaning that they're not going to increase or decrease your mortgage insurance. If in fact your credit score is 800 or a 620, they're going to end up giving you the same calculation of mortgage insurance based off of the loan amount. The differences are going to be when can you actually remove them? When can you take off that mortgage insurance? And that's where the FHA loan ends up being not the best option for being able to remove that mortgage insurance. When it comes to mortgage insurance on FHA loans, it can vary anywhere between 0.85% to 1.1%. So remember what I said before, 0.26 to 3.08, basing on that credit score at 620 to the 740. The difference is that when you go into the FHA, you could have a 620 and have that 0.85. You could have a 740 and have the 0.85% mortgage insurance. The difference is as to when you start moving into the 1.10% is when you actually start increasing your loan amount. So when you pass that standard county limit, that's when you start actually increasing the mortgage insurance, which is going to then cost you more per money per month. So what does 0.85% even equate to? Well, on a same $500,000 loan, we're going to be talking about $354 a month for monthly mortgage insurance for FHA. The difference, again, is that going to be that if you have the higher loan amount, you're going to have a higher mortgage insurance than just that amount of 0.85%, the $354. On the flip side, so now we're going to be talking about not just the mortgage insurance on monthly, but FHA also has an annual upfront mortgage insurance. So this amount is actually financed within your loan amount, and it's added in the very beginning of your loan. Right now, that amount is 1.75% for an FHA loan, meaning that you're going to add on top of your loan of the $500,000 additional money. So you're going to finance more than what the actual loan is. And again, at $500,000, it's going to be 1.75, basing on today where we currently stand in our mortgage insurance requirements, guidelines. Remember, these guidelines change all the time. So if we were to do the math for that same $500,000 loan, remember, we're going to be paying that a $354 monthly payment, but then we're also going to be adding $8,750 on top of that loan. That again is an FHA requirement, so it's not something that we can actually get out of. So another difference amongst conventional and FHA is the mortgage insurance and how long you actually have to keep it. So in many cases, you would think that when you have a whole bunch of equity, you can take it off and it's no big deal. That's not the case, and it's very different from conventional and FHA loans. So on our number 4 difference, it's going to be the difference amongst when you can take that off of your mortgage payment. So on the mortgage insurance, that's when it gets really tricky as to when can you actually remove it when comparing the FHA to the conventional loan. All right, so on the conventional loan, technically you can remove the mortgage insurance when you hit 80% of your value. So value's at $100,000, you gotta be at $80,000 on the loan amount to be able to take that off. Again, that's something that you have to talk with your lender to be able to remove that. On the flip side, we're gonna be talking about FHA loans. FHA loans are not like that. If you put less than 10% down, as an FHA loan in the very beginning, you are going to remain with mortgage insurance the entire 30-year term. When you actually get to remove it is when you decide to refinance or sell the property. That is not going to be something that you can remove from just making a call to your bank, letting them know, hey, I've got a whole bunch of equity, can I please remove it? And that's not going to happen that way. So you're going to have to refinance or sell the property to be able to take off that mortgage insurance. It's not going to be something that you can remove. With that, if you put 10% down, which is not as common when you do an FHA loan, but it can be done. So if you put 10% down on that FHA loan, you're going to find that you can remove the mortgage insurance after 11 years. This is not something, again, that's going to get removed beforehand. Prior rules, prior guidelines, they had you waiting 5 years and up to a specific amount of percentage of equity, but all those rules are gone. It is now specifically 30 years if you did not put 10% down, or if you did put 10% down, then you only got to have mortgage insurance for the 11 years. The FHA loan, more so than anything on this type of factor, is really going to be the loan that you hold on to just for a short period of time. This isn't going to be something that you hold on for those 10 years because a lot can happen in 10 years and you should be able to get out of that FHA loan and into a conventional loan. On to number 5, to the next difference between conventional and FHA loan. The tax deductibility as to that mortgage insurance. This is an easy one. When you go to the left on conventional and you go to the right on FHA, they are exactly the same. It is all up to your CPA, whether your CPA tells you that you can or cannot deduct that from your tax returns on an annual basis. And that's something that you need to talk to your CPA about to determine which and what you can actually do, because everybody's situation is completely different. Maybe you can, maybe you can't, but that's not up to a mortgage consultant to be able to determine. On to the next difference between conventional and FHA, and that's the debt to income. What is that? DTI. Oh, it's the same thing, debt to income. The debt to income is very different when it comes to conventional and when it comes to FHA. Well, again, FHA, you're going to find that it is a bit more lenient. Conventional is a bit more restrictive. And going back to that mortgage insurance that we were talking about a second ago, it is a bit more expensive when your debt to income is higher than the typical requirement. So on a conventional loan, you typically want to be within 40% to 45% of your annual income. So what does that actually mean? You make $1,000, the bank, lender, broker, direct lender, they want you to be somewhere in the line of $450 out of 45%, $450 out of that $1,000 of income, okay? The difference amongst the FHA loan is that it's a bit more lenient. They will allow you to go 45, 50%. In some cases, some lenders can even go up to 55%. Of course, again, the more you push the limit, the more requirements you're going to need to have. Okay, so again, looking at FHA, let's just go standard amount at 50%. 50% out of that $1,000 is going to be $500. And so you typically want to spend under $500 for everything. That's the mortgage, the principal, the interest, the taxes, the insurance, all of your debt, the car loans, the personal loans, the credit cards, all of that good stuff. But it doesn't include any of the extras. So like your child care or like your phone bill or the solar or anything like that, that's not included in those calculations. However, if you're buying a home that has solar and it has a new payment, you may have to qualify for that amount. So that's going to be another video for another day, but just a little quick tip that you would need to qualify for that detail, whether it's a conventional or an FHA loan. So debt to income, we're looking at about 45% when it comes to a conventional loan. However, when it comes to an FHA, we're kind of lenient here, and that's where we go to 45 to 50 to 55%. And that's all a decision base. So when you click that button, does it allow you to go that high or does it not allow you to go that high? Meaning, can you spend that money or can you not spend that money? You always want to make sure that you have the ability to repay. And what does that mean? It means that you want to make sure that you can actually pay back the mortgage to the company of where your mortgage is currently at. And so you want to make sure, even though the bank or the lender or the direct lender can do this, you want to make sure that you can still afford it, so that it still calculates out to your comfortable payments and it's still doable within your own family. On to the next difference when it comes to a conventional and an FHA loan, and that is the bankruptcy foreclosure requirements. So in conventional, this is pretty restrictive. We're talking like 4 years and 7 years. So 4 years is the more lenient option, but 4 years, it's talking about extenuating circumstances. So what does that even mean? It means that something happened in your life that you could not have gotten away with, like meaning you could not have avoided at any point in time. So it's not the market crash. That's not an extenuating circumstance. It's not I had to file bankruptcy because I got a divorce. That is not an extenuating circumstance. So it's something that you could not have avoided. And so something like that is really case by case basis when it comes to your lender as to whether they're going to or not going to be able to do that. But regular guidelines are 4 years. When it comes to a longer period of time, when it comes to a foreclosure, you're looking at 7 years. And so during this purpose of COVID, there was a lot of clients that went through a forbearance. And a forbearance back before COVID would have technically meant that you were in a foreclosure, which meant that you had to wait 7 years. That's very different, and those guidelines have changed, which in fact would then allow you to do something that you wouldn't be allowed to do more than a year ago. So those details have definitely loosened up. On the flip side, we're looking at FHA. FHA in general is pretty allowing with regards to not requiring 4 and 7 years. When it comes to a bankruptcy or a foreclosure, you typically just want 3 years for a Chapter 7. Then when you look at a Chapter 13, that's when you get a little bit more lenient. You're looking at a year. that also needs to be shown with some ability to repay. Again, going back to what I was talking about earlier, that you want to be able to make sure that you can not only afford this payment, but that you can also be able to pay it back to the mortgage company of where you currently have your mortgage. Another detail that we need to be aware of is that under FHA loans, they don't like collections, which means that if you have more than $2,000 in collections, that's going to be a hiccup. You're going to have to set up repayment, pay them off, or you're going to have to assume that you're making payments and qualify with those payments, even though technically you don't have any. So that is a new FHA requirement. Not recently, that was a couple of years back, but it is still really important because a lot of lenders forget that collections are not the same and you can't just write them off because they're already in collections. If it is a charge off, that is a whole nother story that you do not have to include those in your qualifications. However, keep in mind that again, this is all about derogatory credit. And so therefore you are going to get viewed when it comes to those charge offs just a little bit more. You need to make sure that again, you have that ability to repay. So on to the next difference, which is going to be occupancy. So do you have to live in the house? Do you not have to live in the house to be able to get these different programs that we were talking about? Conventional with 3% down, FHA with 3.5% down. Well, basics are yes, in order to get the 3% down, you need to be able to live in the property. Assume that you're going to be living there or already being living there, okay? The other details that when you're assuming a conventional loan, you need to be living there as your primary residence, or assuming that you're going to be living there as your primary residence. So that would be the 3% down payment requirement. The difference though is that when you look at FHA loan, FHAs will allow you not just to buy one unit. So technically speaking, you could buy 4 units, meaning a quadruplex, live in one and rent out the other 3 for the same 3.5% down payment. So technically speaking, yes, this is still your primary residence for one of the units, but you could rent out the other 3 to give you multiple options for an investment aspect. This is something that can be pretty common in your area, depending on how expensive the quadruplexes, triplexes, and duplexes are, because depending on the sales price will depend on whether the ability of being able to do the quadruplex, triplex, or the duplex is an option. And just like anything, anytime that you start making it a little bit more complex, meaning that it's not a regular house, and maybe it is that duplex, quadruplex, or triplex, you are going to carry different interest rates, and you're going to have different requirements when it comes to the assets, when it comes to what you need to have in your checking and your savings account. And that's what brings us into our next difference between conventional and FHA. So on the differences of the down payment, where they're coming from, so your assets can be your checking, your savings accounts, your retirements, your IRAs, your 401k, all of that good stuff, okay? So that can come in for a regular conventional loan. And then you have your regular 3% down. The difference is that when you compare that to an FHA loan is a little bit different in the fact that you not only you need your down payment of your 3.5% down, but you also need the additional money in the bank. So that's that little extra buffer money that you're going to need in order to make sure that if something were to happen, meaning that if, for example, another one of these happened, a pandemic, you'd be able to make your mortgage payment. And so with pandemic, with this COVID, it changed everything and changed what we didn't used to require, which was no extra money after you close, to now that is required. You have to have a minimum of 2 months of payments inside of your bank account after you close. So let's go back to that $500,000 loan amount that we were just talking, okay? So your loan amount is $500,000. We were talking about the monthly payments with regards to the mortgage insurance. So let's assume that your down payment for that same $500,000 was going to be same 3.5%. So that's going to be $17,500. Now we got to talk about the extra money that would be required to be inside of your bank account after you close. So you have the $17,500, which is your down payment, and then the next piece of the detail that you're going to need is going to be the reserves. So the reserves, meaning the $3,000 that we are going to need in your bank account, more than just the down payment of $17,500, is going to be your reserves. So the reserves are going to be 2 months of payments of your regular payment. So let's assume, back to what we were saying, monthly payment is $3,000. So at $3,000, 2 months of $3,000 payments is going to be $6,000. So we said 3.5% of your total sales price. That is going to be $17,500 plus the additional $6,000. Now we're talking about $23,500. This is not including the closing costs, which honestly in this market, it's going to be really hard to get, but we're more so talking about the requirements as to the assets of what you need to have in your bank account. So there was a lot of differences when it comes to a conventional loan and an FHA loan, but in our last difference, which one is the best one for which type of client? So if you have a conventional loan, most likely you're going to have a higher credit score, meaning that we're not going to be in that 620 credit score requirement because that mortgage insurance is going to be really expensive. And let's not even consider the actual interest rates. Yes, our interest rates are at a dramatic low. However, when you look at the 620 credit score plus the higher mortgage insurance, your monthly payment is going to be a bit higher. So if you have good credit history, no derogatories, no bad credit in the past, bankruptcies, foreclosures, short sales, none of that stuff, the conventional loan is going to be the best option. However, if you have something like that, so you had a bankruptcy in the last 3 to 4 years, 5 years, the FHA loan is going to be the better option. Or maybe you don't have a perfect credit score, or you just have that 3.5% down payment. Well, then the FHA loan is going to be the option for you because you don't want to go through as much of difficulty on a conventional loan where you are scrutinized more and payments are higher, rates are higher when you don't have the best of credit score. Whereas an FHA loan, they are a bit more lenient. And last but not least, we were talking about the beginning of this video, down payment assistances. So to top this off is that down payment assistances can be connected actually to both conventional and to an FHA loan. Within the down payment assistances, this is something that we use within the state of California, where they help you with the down payment to lessen the money that you have to require at closing. So they're lessen the money that comes out of your pocket, whether it's a conventional or an FHA loan. There are different options when it comes to that. So this was a loaded video with a whole bunch of differences coming from the credit score, the down payment, the debt to income, with so many details that come along with conventional and FHA loan. So by no means do I expect you to be an expert, but if you have questions about conventional and FHA, or you're thinking about moving and relocating to San Diego, California, I would love to be able to help you. If you're curious about what it's like to eat, live, sleep, and play here in San Diego, California, or you're curious about any of these other best home loans that are the best for you and your family, make sure that you click on one of these videos right over here. There's a whole bunch of new videos that get released from my channel here every single week. Until next time, have a good one.